freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here with my partner in crime, Adam Penn. Adam, how are you today, man?
Don't say that we've committed crime on a recording.
Oh, okay.
Is that just like a joke?
Well, yeah, of course. Why are you concerned about
the actual crimes? No,
okay.
No, I'm not concerned. No, I'm doing good today.
Good. Well, it's good to see you, as always. Well, not always, but most of the time.
I feel like we've got a lot of deals going on. We're working on like monthly updates right now. We're doing that right before we hit record, and there's a lot of like monthly updates to be working on.
There's a lot of stuff in the hopper right now, for sure, of existing deals, of potentially new deals that we're working on, and
you know what I think
of various types too, right?
Might be interesting to offer out to people is we have a deal observer thing that we normally only give to like people that are talking about the deal before we do them. But basically, if we're talking to someone and they're like, "Hey, I'm not going to invest in this," I'm like, "Okay, that's fine. Would you like to watch the deal and just see how it goes?" And we put you on the email list, and it kind of gets a little add-on flag that says you're just observing the deal, but you get to see how it is. I think it might be interesting that if anyone wants to see how any of our current deals are going, we could add them as a deal observer if anyone wants to see that.
Yeah, for sure. Especially since most of those are not most. Well, I guess the only one that's not would be the credit fund, but the credit fund's always open. I was going to say all those deals are closed for investment, so there's no we don't have any securities concerns on any of that. And we'd definitely be happy to do that. We've got that functionality that we've built into our reporting system, and we like to keep people up to date. If they want to see the exact same updates that we're sending to our active investors, we can on a case-by-case basis add you to certain deals, and you can follow along. And I think that's been a good thing for folks that want to have a little bit of time to think about investing, see how things go, and there's certainly nothing wrong with that. But yeah, I'm glad you brought that up. We'd be happy to do that.
Send us an email if you're interested.
Absolutely.
What are we talking about today?
Well, I think you had a topic in mind, given that it's getting to be the end of it. We're definitely in the latter part of the year now, and people are starting to think about taxes. And there's sometimes you've got tax optimization decisions will drive investment decisions. Sometimes for the best, sometimes that might not make as much sense. And so I think this was a topic you had originally thrown out, and we've contemplated talking about before, but finally decided that now was the right time to do that. So I don't know, any initial thoughts as we launch into this topic?
I think the biggest thing is just that taxes are something you should plan around, right? Not so much like you should plan for. You shouldn't plan to pay a high amount of tax, but you should definitely plan around how to pay the least amount of tax legally possible. And I think what happens with most people, at least a lot of W-2 earners, is they go through the year, and then around March, they're probably like, "Hey, I need to file my taxes." And they go file their taxes, and they're like, "Well, how much did I make? And what can I do to offset that?" And I'll just kind of tell you right now, if you're trying to figure out how to offset your income in March for the prior year, you are too late. Because we work on this silly system that's annual. And if you want to do something to offset that income, it needs to have been true for the previous tax year. So we see a lot of deals get done in like the last 3 months of the year, especially some oil and gas ones, because they happen to have high tax benefits. But I think really where I'm going with this is just that there needs to be planning, right? And so personally, that planning looks like at the very beginning of the year, loosely, by the very beginning of the year, I will have filed the previous year's taxes. No, I wouldn't have. I'll have a rough estimate of knowing how many losses I had carried forward, right? I'm going to have a loose estimate from, at this year being 25, going into early of 26, I'll basically know, because I did enough planning through 25, what my tax liability is and how much extra losses I have to carry forward. And so if in 26, I can start by knowing, hey, I've got a $100,000, $300,000 loss carry forward going into the 26 year, well, then I know for the first $300,000 that I make, I don't have to worry about finding an investment or another activity to offset that income. And so what that means to me is that normally around halfway through the year, I can do a tax planning session, which part of this comes back to having good bookkeeping, right? It's easier if you're just a W-2 employee. But, even if you've invested in syndications or other things like that, what have you been paid out so far? And I do this tax planning session normally around July, middle of July, end of July. And that allows me to meet with my CPA, have all of my QuickBooks files closed out, all of my earnings closed out for the first 6 months of the year, and say, this is what I made in the first 6 months of the year. Maybe I have some plans for some bigger exits later on in the year, whatever. I can note those. But for the most part, it's just, this is what I made in the first half of the year. This is what we think we're going to make in the second half of the year. What are we looking at? And that lets me start thinking about what I need to offset by the end of the year to reduce my tax liability. Either fully, I always try to go to a full offset, right? I try to pay $0 in tax. I think I paid $300 in tax in the last, in income tax. We pay copious amounts of other taxes, but income tax in the last 5 years has been about $300. And so it's all planning. It all comes down to planning. But then, I'll switch back over to you. But from there, there's, talking about what types of investments we do to offset some of those.
Yeah. No, I think that's definitely the first part and the starting place for this. And we've had a few episodes. We've talked about taxes before, but that really is where it all begins is proper tax planning. And it's, to your point, it's not something that you start, most people they're sitting in, a February or March and they're like, oh, what deductions can I take from the previous year? And that you're too late, right? Cause to your point, Adam, the activities, with some exceptions, typically they have to occur within that calendar year. So, January 1st clicks over, your opportunities to have done things to offset income or do anything else for tax planning are kind of done. It's effectively locked. And so you really need to be, to your point, forward looking and very proactive about this and looking at it, at the start of the year. And then I love the fact you've got this mid-year sort of catch up to see where things are. Another thing you touched on was just W-2. And, this is something I first heard through Robert Kiyosaki and sort of started learning there through Rich Dad, Poor Dad, was just how few opportunities and how the tax system is really not set up to allow for W-2 earners to have a lot of deductions against that income. There's people talk about real estate as being great for its tax benefit, and that's very true. But there's also, if you are a W-2 earner and you're expecting, if you have a high income W-2 job and you're expecting to buy some real estate and or invest in, say, a syndication and take some depreciation from that, you're probably going to be sorely disappointed that alone is not going to offset your W-2 tax burden. Even the same thing for just any other type of active income. You really have to be mindful of how, for one, how your income is earned, and then how that gets viewed by the tax system, and then that all factors into your planning. And we're not CPAs. We've talked to a lot of CPAs over the years. Adam and I have both personally done a lot of our own tax planning, but this is definitely something that you don't want to try to do on your own. You want to engage a professional, a CPA, early on to, again, have a plan, not a retroactive, what can we take advantage of from the past year? Because when you're proactive about it, you have a lot more opportunities to actually have a meaningful impact on that tax burden and take activities to offset your tax liability.
And when Dustin says, talk to a qualified CPA, a tax planning professional, he means a qualified CPA, not someone with a CPA license. Those are different. And I think I have a good question you can add to if you want. But if you go ask your CPA, you can write this down. I have real estate professional status and I bought a building. I would like to do a cost segregation study on it and take advantage of bonus depreciation. What do you think? If they say they don't know any of the terms you just said, whether or not you know what they are, you can Google it, you can put that into ChatGPT if you want. But if they don't know any of the terms, or if they say no to any of the things, other than maybe they might say you don't qualify for real estate professional status, and that could be true. But
or tell you that's too risky.
If they tell you that's too risky, once again, we're not tax planners. Do with what you please, but I would say fire them and find a new one. Basically, at the end of that meeting, be like, "Thank you. We're not working together anymore. I will be hiring another professional." You're leaving too much on the table because all that person you're working with knows how to do is file the forms, which TurboTax knows how to do. That person should be asking all of the questions to how to reduce your tax liability. And a lot of those things I just said were, the biggest one for W-2 earners, I'll say the biggest two, the safest one and then the second safest, or the safest one and then the other one that I know of is, safest one is buy a short-term rental and put 100 hours into it. Operate as a short-term rental. You can take the depreciation on it. It's an active business. You can offset the W-2 income. The next year, you can hand it over to a manager if you want. They're separate businesses. Once again, these things are grouped by tax year. Once again, not a CPA, can't provide tax or financial advice, but that will give you depreciation and you offset W-2 income. That's what I did when I was a W-2 employee. I had short-term rentals that I actively managed. I either did some cleanings, I did guest management, I set them up, I did all these things. You just have to have 100 hours in a year and you have to be more than anyone else. So you can't have a cleaner work 101, things of that nature. You'd have to do 102 then. All of that to be said, then you can offset your W-2 income with the depreciation on that, which is huge. You could buy one house and wipe out your W-2 income. Second to that is you could invest in oil and gas, general partner, oil and gas, active benefit. That's a possibility too. There's higher risk in that, I think, than buying a rental property. But that's if the rental property performs well. I know some high earning doctors that buy short-term rentals that are right now negative cash flow. Yeah. Not huge, few $100s a month, maybe call it $500 a month. And I don't care. It offsets so much income that it doesn't matter.
Yeah.
Obviously the goal, we manage one of those and I'm like, well, I'd like it to make more. He's like, well, I need to refinance, interest rates up at 8%. There's reasons that it's more expensive, but the depreciation was enough up front that it didn't matter to him.
And I'm glad you kind of veered into, I think, the second half or the second side of this conversation, which is the actual decisions to make. And the different strategies, which there's a lot. You touched on what's typically known as the short-term rental loophole, which I don't really like calling it a loophole because it's not, right? It's written into the tax code. It's not it's not some loophole. It's just following the rules. Code. Yeah. There's no loophole here. But the bigger thing I think from my point of view that, and Adam, you and I have seen this a lot. I think people need to be mindful of letting their tax optimization drive investment decisions. Now, to your point, you just mentioned, you know some folks that are losing a couple $100 a month on short-term rentals from a cash flow standpoint, but they're kind of making it up because of the tax benefit that it provides.
Mortgage buy down, appreciation, all the things.
Yeah. So that's not really what I'm talking about. I think the bigger thing here, again, Adam and I know multiple people who kind of fall into this bucket to where we'll see folks that will make borderline irrational decisions about investments in order to avoid paying taxes. And
not illegal,
again, whether that's right, wrong, go ahead. What?
I said not illegal, but irrational.
Irrational, yes. Where even in instances where they are okay with what is a bad investment, if it's the alternative of making a bad investment or paying the money to the government, they prefer to make the bad investment and take the risk. And that is every individual's decision. Now, that's not the decision I would make, but I think it's something that you have to be mindful of. And I think everyone, if you go into it knowing it, it doesn't matter. I don't want the federal government having this money. I'm fine I would rather lose it than write a check to the federal government, then that's fine. But I think you get a lot of people that tend to get myopically focused on, I don't want to pay taxes. And so then they'll go and start looking for all these things. And, even I know a guy was talking to out at the airport a couple of days ago who was talking about he had recently done he had sold a property, decided to 1031 because he didn't want to pay the taxes on it, and ended up buying a property that he had no business buying and lost a whole bunch of money. And he was like, I should have just written the check. He's like, I was so focused on, I don't want to pay taxes that I let that lead me into a bad investment decision, and I lost more money than if I had just written the check. And so I think that's, again, we talk often in so many things about how it's important to know yourself. It's important to know your goals, know what you're looking for. I think this is another one of those areas where, again, if you're content saying I'd rather lose the money than give it to the government, totally fine if you know that about yourself going into it. But you definitely don't want to be one of those people like the guy that I was talking to who now regrets an investment decision that he made because he realizes he got so caught up in not trying to pay the tax. So I don't know. I'll stop there. I don't know if you've got any other thoughts on that.
No, not on that. I mean, at the end of the day, right, it all comes back to a math problem, right? You're working through where you want to put your portfolio, what you want to invest in. And I think so often people look, and it's not even just this year, right? It's what are the tax implications for the next 10 years, right? We have a oil and gas deal we did with Aspen Funds where it's tax shielded essentially, inside of the fund, there's enough tax benefits, your income won't be taxed for 10 years. Well, that's part of an investment decision, right? If that means I'm going to earn money for 10 years on this deal that is non-taxable because of the way that this vehicle works, like that looks different than the identical deal that I'm going to pay taxes on every year or have to find something else to offset it with. So I think that at the end of the day, tax needs to be a thing that it's such a high tax rate in this country, right? I mean, maybe not compared to others, but compared to what it should be, it's astronomically high. And you're already taxed on everything else in life. I could sell a car to Dustin and he'd pay tax on it. He could sell it back to me and I'd pay the same tax. And we can go back and forth until we paid the entire car's value in tax and we'd still have to pay for the freaking car. It's stupid. And then you have to pay sales tax on every purchase you make. I mean, that is a purchase, but that one's a little crazy to me. You have to pay registration fees, which are a tax. You have to pay property taxes. You have to pay, I don't know, Dustin, there's probably 10,000 other ones there. We have Airbnbs in Memphis. I think the freaking tax rate on those things, that the hotel tax on all of them, when you add state level all the way down to the city, is like 23%. It might even be upwards of 30. So that means someone, let's say a high W-2 income earner in California could be paying 60% tax on their income. So now on $100, they have $40. They could go to Memphis and buy a $40 Airbnb, but out of that, $12 went to taxes. So only really got $28 of the Airbnb. So that goes to me. But in Memphis, I'm going to pay property taxes, which is probably going to be about 10%, maybe 5% of my net income at the end of the year, right? It trickles down. You pay so much of it. So you need to put planning into the beginning level of it, which is the money you earn, especially if you're W-2, because, and I'll get off my soapbox, but the employer is paying payroll tax on that too, whether or not you get all your deductions.
Adam, you're not at all passionate about this, are you?
It's just stupid. I mean, you could think back to the conversation that me and you had with that investor who didn't want to pay tax. I'm not that passionate about it.
Yeah. No, I know. And that's what I get. Like, again, some things that might be irrational to me and you or make sense to someone else. And I will say is passion. You are more passionate about this than I am, but even you, like you've drawn your line, right? Like, kind of how far you're willing to go to not pay tax. But I also feel like you are, and we've talked on this we've talked about this idea in previous episodes about getting creative, right? And asking the question of, okay, well, what can I do to offset this tax? And the importance of having an open mind, whether that's short-term rentals or oil deals or whatever. But again, it all comes back to like planning and working with a professional that understands this space, that shares a similar mindset. Again, maybe your CPA is not completely crazy about not ever paying tax, but they will work with you to like whatever your comfort level is and help you find the right strategy. Again, ahead of time, right? Like earlier in the year when you're starting to define this is the time to be thinking through this. You can't make these changes after the year's already ended. Like these have to be proactive decisions.
And I think really, and maybe this closes it out unless you have something else, is that I know we've said planning a lot, but I'll give an example of this year. I worked a loosely W-2 job. It was a contract. I think it was taxes W-2 for half the year. So it's 1,000 hours, 10,040 hours I have into that job. So for me to have real estate professional status, I would need 750 hours in the leasing or rental of real estate, of rental real estate. And it would need to be more than my other job. So if I have another job that was 1,040, I need to put 1,040 hours this year into real estate and the leasing and rental of real estate to qualify for real estate professional status. Well, that's something I need to know about basically as soon as that job ended, that I need to make sure I have this hour log, and I already had hours from before that I could add to it. And, where am I going to get at the end of the year to know that I'm getting to my 1,040 plus hours? And I do a lot of leasing. We bought some buildings. I kind of run a lot of it. So I'll have more hours than that. I mean, I probably have 500 hours from the first half of the year, even on top of that W-2 job. But all of that pairs together, and having those records to say that, yeah, now the depreciation on some of these other buildings I bought can offset it. Because I was looking at, well, now I need to go do an oil and gas deal of like $100,000 to offset my taxes, which is a little more risky than I want to be right now. But instead, now I have reps, so I get this depreciation, and then I just need $25,000 in an oil deal, which I'd love to add that to my portfolio.
Yeah, I mean, I think, I don't know, to probably round all of this out. So much of it just comes back to, like we've said, the planning, to being proactive, to having the right team in place. It's all the things we've talked about all this before on this podcast. I've written about it, right? Having the team in place. This is something that's not, it's tough to do this on your own. It's not wise to do this on your own. You need a team of advisors, and the CPA that can help with this is one of the big ones. And then being willing to explore different strategies and things like that, and then know exactly how much of that, how much you want to let the tax tail wag the investment dog. Some people are more than others, but you need to be comfortable with your own situation there, and whether or not it's worth trying to find some sort of investment or trying to offset it. If you're like, you know what, this is not worth making that decision. I hate the idea of this, but I'll just write the check. It's fine. And whether that's because you're out of time or whatever, timing on some of these things can make a difference, right? Like if you end up with a large windfall or something late in the year, that's kind of a worst case scenario, because then you are out of time. Like if it was something you couldn't plan for, we kind of had this happen with the startup acquisition. I mean, that was finalized in late November, right? So sitting here with a hair over a month trying to figure out, okay, what about all this taxable income? So, there's things like that can happen, but just sitting down, and to the extent that you can, having a plan for this and knowing your tolerances, and having the advisor. I think those are probably the three big takeaways for me from this episode.
Yep.
I don't know. Any final parting thoughts here, Adam?
Nothing else for me.
All right. Well, we'll get out of here for this one. Everybody, we appreciate you listening. If you enjoyed this, as always, go give us a thumbs up, give us a positive review at Apple or whatever you do on Spotify, and subscribe to the show on YouTube. Let the computers know you're enjoying what you're hearing. We very much appreciate it, and get the message out to more people. But we will catch you on the next one. Again, thanks for listening. We'll see you later. Just remember, where freedom leads, where wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.